Good morning, everyone. Welcome to the combined subcommittee meeting. Faith Rents is out of the office today, so I will be facilitating this morning's meeting. Carol did confirm that we do have a quorum of the combined subcommittees, so I would like to call the meeting to order. And I would like I guess the first agenda item is the approval of the July 15th Combined Financial Health Policy and Planning Subcommittee meeting minutes. Those are displayed on the screen. So once the members have had a chance to look at those, I'm happy to entertain a motion.
This is Bert Scalati. I'll move to approve.
Thank you, Bert. Is there a second?
This is Courtney. I'll second.
Thank you, Courtney. All right, all in favor?
Aye.
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 Are there any abstentions? Or nays? All right. Hearing none, those minutes are approved. We will move to the director's report, and I just have a couple updates to share this morning with the subcommittees. And these are around the 2024 request for proposals that we have shared with you in the past. There's currently 3 that are out to bid. The first is for FSA, flexible spending account, pre-tax commuter, and COBRA. The effective date for this contract award will be July 1st, 2025. The RFP intent to bid closed on July 22nd with 5 confirmed bidders. The Statewide Benefits Office and Willis Towers Watson did provide responses and posted those responses to vendors' questions on August 2nd. And bids were due last Friday by 1 p.m. We received 3 bids. The bids received were from the incumbent ASI Flex, from Total Administrative Services Corporation, or TASC, and the third was from WEX Health Incorporated. The next step is that SBO, with the help of Willis Towers Watson, will be reviewing the bid responses, and we will be preparing for the proposal review committee meetings, which begin in October. The second RFP that is posted is for the Employee Assistance Program. The effective date for this contract award is also July 1st of 2025. The RFP was posted on July 15th, and we received 9 intent to bids. We also posted responses to vendors' questions on August 9th, and bids are due by this Friday at 1 p.m. And the third and final RFP that is posted is for accident and critical illness insurance. The effective date of this contract award is also July 1st, 2025. This RFP was posted on July 15th. We received 4 intent bids. We posted our responses to the vendors' questions on August 9th. And again, bids are due by this Friday at 1 p.m. Are there any questions on any of the current requests for proposals that are posted? Okay. My last update is around the state of Delaware Medicare open enrollment. Open enrollment this year will be October 14th through 25th of 2024. Key dates and planning updates will be provided to the SEBC at their meeting on Monday, the 26th. All right, so now that we're done with that, I think we're on to financials, and I think I'm turning it over to Brian Stitzel from Willis.
Thanks, Leanne. Good morning, everybody. I'm going to go through the development of the trend assumption for FY25 and forward, detailed development of the FY25 budget, and then actual July fund results. What's included in the packet includes the plan financials for FY24. I don't intend to go through that in any detail unless any of the subcommittee members have any questions specific to that. So diving right in, let me share my screen. On the trend development, a lot of the slides are the same from what we've gone over the last two subcommittee meetings, with a couple of, call it, key updates. So recall this exhibit which showed historical trends split by group, meaning actives and pre-65 retirees combined, and Medicare retirees, and then separately medical versus drugs. One of the key updates here is that when we presented this last month to the SEBC, we initially had a recommendation on the non-Medicare medical side of 6%. The SEBC specifically asked that we increase it to 8% to be in line with the average that we've seen over the past 4 years. So that's one key change. And then the other, recall, we had taken a hard look at the GLP-1 utilization, and specifically the utilization and cost increases on a month-by-month basis. We initially had a proposed assumption in here that going into FY25, utilization would increase by 2% per month. Recall that the subcommittee had requested that we both potentially change Q1 to 4%, as well as wait until we had July experience to see if any of the utilization increase spikes had waned. You can see July is here in red, and it obviously has not. So July versus June was another 21% increase month over month. So you can see the pretty high running monthly rates, starting in March, 45, 31, 23, a dip down to 6, and then a big spike back up to 21%. So based on that, we've revised the recommendation to have it come down off of that 21%, somewhat gradually down to 2% by January of 2025. So an assumed 15% increase in August. Again, this is monthly. So versus July, 10% September, 5% October, 4% November, and then down to 2%. The graphs here on the right give you a visual of what those assumption increases would look like. So the top graph is on a monthly basis, and claims would start to level off at around the $5 million per month standpoint, showing all the way back to 7/1/23 when GLP-1s for weight loss were first covered. And then the bottom graph is taking these assumptions and forecasting it out through FY28 and what the increases would look like in gross spend on an annual basis. Then similarly, on the GLP-1 utilization for diabetes treatment, you can see that historically the monthly trends have been a high number, then a negative number, high number, a negative number, probably due to the fact that people are filling 90-day scripts. So it's blippy that way. But the key point here being that July was also a big month on this side with a 12% increase. So assuming an overall average increase of 1% per month would mean that net GLP-1s for diabetes treatment on an annual basis would increase by 35% in FY25 compared to FY24. And that similar number was 45% in FY24 versus FY23. And then again, the same two charts showing the increases on a monthly basis and then increases on an annual basis. So if we go with those assumptions and are assumed to be recommended to the SEBC for approval, we have a forecast here of, what the pharmacy aggregate trends would look like both on the commercial basis and the EGWP basis, with that same, call it, component buildup of trend assumptions, meaning 9% for gross medical, excluding GLP-1s. You see 272% here. This is annual year over year for the weight loss. That's these monthly trend assumptions converted to an annual basis. So 272% expected increase, forecasted increase in FY25 versus FY24. That same 34% that we just talked about here, it's rounding, some rounding in the numbers, 34, 35% on the GLP-1s for diabetes. Continued increase in savings from Prudent RX. That would give us a net overall aggregate pharmacy trend on the commercial plan of 29% versus FY24. Going through the same exercise for EGWIP, it would be 11% on the EGWIP side. So we're talking about bifurcating the trend assumptions and looking at them separately by the two separate groups. And then going into the future, again, we're assuming a leveling off at 31% of the increases in GLP-1s for weight loss, having the increases year over year start to go down over time. Same thing on the diabetes side, going from 34% down to 10%. And then on the EGWIP side, again, having it ratchet down to 10% by FY28, and what the overall pharmacy trend would be in the aggregate of those separate components year over year. So those are the big highlights of the trend assumptions. Let me pause there for questions, as well as coming to a conclusion or consensus about whether these will be the final recommendations that we bring back to the SEBC for approval. Lorianne, I see you have a question.
Hi, yes. Can you go back to the previous slide, slide 4? I just have a clarifying
Sure.
question.
Sure.
So if you look at the bottom table, if you look at July and August, the claims are the same and there's a 0% month-to-month increase, but the projected cost is higher. Can you explain why costs would be higher when the claims are the same, and how you
Yeah.
do those calculations?
Yeah, it's just rounding, because what is also factored into all of this is an expected monthly increase in membership. So we have an overall assumption in all of our projections that membership will grow, I'll simplify it, by 1% on an annual basis, but that's converted back to a monthly basis. So it's like, less than 0.1% change. So it's just rounding in the numbers.
Okay, thank you.
Sure.
Hey, Brian, this is Bert.
Hey, Bert.
When you look at these numbers, do you look at both price per script as well as the number of participants?
Yeah. So the price per script data has been fairly consistent. So we're not sort of seeing a double dip in a way, or a double hit in that utilization's going up and price is going up. It's almost exclusively driven by utilization. And we can certainly add that. We have that data. We look at it. It's probably buried in the hidden columns in the charts. We can, going forward, we can also track that, just so that we continue to share it with the subcommittee and the SEBC. We'll show the average price per script data as well.
Thank you.
Sure. Any other questions from the group? So Leanne, I don't know if at this point, do we pause here and ask whether or not these will be approved recommendations to take back to the SEBC, or do we wait till the end?
So I think we could do it now.
Okay.
Yeah, so if there's no other questions for Brian, is there a consensus from the subcommittee members that these are the right assumptions that we should recommend to the SEBC for their discussion at Monday's meeting? Okay, thank you, Bert.
Excuse me. Yeah, this is Bill Oberly. I did have one. I missed the number on the gross increase for pharmaceuticals on retirees. I wonder if you can repeat that for me.
Sure. So you're talking about specifically the Medicare retirees?
Correct.
Correct. So that's on the screen. The bottom half here is the EGWIP. If you flip back you can see here that, again, going through the same building block approach, we're assuming 9% on gross spend without GLP-1s. GLP-1s on the medic fill side, the EGWIP side, increased by 30% in FY24 compared to FY23. So on a go-forward basis, we're assuming the 30% goes down to 25 in FY25, then 20 in FY26, 15 and 10 by FY28. Therefore, the aggregate at weighted average trend assumption would be 11% for FY25, 10% for 26 and 27, and 9% for FY28.
Okay, thank you.
Sure.
All right, so hearing no other questions, concerns, it sounds like the trend recommendations that Brian went over for commercial and EGWIP are reasonable and should be recommended or shared with the SEBC at the next meeting. So
Can you,
thanks, Brian.
hi, I have a question. Can you clarify exactly what numbers you would be recommending, just to make sure, like, is that on this current page that we're looking at?
That's right. So Lorianne, it would ultimately be these columns of numbers, meaning the independent separate trend assumptions by component. So the same gross 9% trend on pharmacy without GLP-1s, and then the annual increases in GLP-1s. The 29% is really just a weighted average aggregate buildup of those, but it's really these assumptions that we're seeking approval on. And then since we provide long-term projections on an ongoing basis, it's also seeking approval of, for now, what these future trend assumptions are, meaning the ratcheting down ultimately of the GLP-1 increases year over year into FY28, although we'll certainly revisit FY26 trend same time next year when we go to set FY26 budget.
Okay, thank you.
Sure.
I do have just one more question.
Sure.
So for FY24, I mean, you're just showing us the comparison for
Yes.
what the previous ones were, right?
That's
Or
right.
the previous
Yep.
assumptions were, but so there was no previous assumption for GLP-1 weight loss?
So in FY24, it was the first year that GLP-1s were covered for weight loss. We had assumptions baked into budget as far as spend, but not any separate kind of independent trend assumption.
Okay, thank you. It's just helpful to know, like, the changes that we're making from
Yeah.
previous fiscal years. So thank you for that.
Yep. You bet.
All right, Brian, I think you can go to the next financial item.
Awesome. So the next piece we'll cover is the development of the FY25 budget. All of these exhibits assume the trend assumption that we just reviewed. So everything in here already has those trend assumptions baked into these budget developments and forecast developments. From an enrollment standpoint, recall earlier I stated that enrollment is assumed to grow by 1% per year. There's a little bit of a caveat here in terms of budgeting. If you look at the numbers, on average, over the past couple of years, it's actually grown by closer to 2% per year. So over the past 2 years, the total enrollment from July to July has grown by 4% for the 2-year period. So what we're assuming here ultimately is we're taking actual open enrollment results from the non-Medicare population, right? So the plan year started 7/1/24. We know what the enrollment elections are. That's why this row here is black, because these are actual July open enrollment results. And then we take those contract counts and we have them grow going forward on a 1% per annum basis, or 1/12 of 1% each month going forward. So ultimately, the average of FY 25 versus FY 24 will be closer to 2% in total. So just an update in that one assumption. We've been relatively short the past couple of years in terms of projecting membership, which obviously has an impact on expected claims and premium contributions. And you can also see that enrollment has been shifting, excuse me, over the last couple of years, with people moving out of the HMO and into other plans, particularly First State Basic and CDH Gold. So First State Basic has been up 29% over the past couple of years, with Gold up 16%, and then HMO enrollment actually down 4%, dating all the way back to FY23. From a premium contribution standpoint, recall that FY25 rates are 27% higher than FY24, and on a calendar year basis for the Medic-Fill population. You can see certain cells are highlighted in a dark brown with white font. All that is there for is to just help the subcommittee understand the timing of when the rate actions go into effect. For example, payroll, state employees on payroll, the premium contributions that come into the fund are basically lagged on a 2-week basis because of how payroll works. So for example, in July, the premium contributions that we collect are actually half a month's of June's premium contributions and half a month's worth of July's contributions. So that 27% rate increase only gets factored in half of a month in July for this population, and then will be fully in for August. That's why you see a big jump, 2 big jumps, one from June to July and then July to August, and then it levels off just for changes of enrollment. On the retiree side, the state share of retiree contributions are lagged on a month basis, so you don't see that 27% increase until August hitting the fund. But from a pension payroll contribution standpoint, it's current, meaning July is reflected in July. Similar impact on the Medic-Fill population, but again, that rate action doesn't go into effect all the way until January of 2025. And then on the non-payroll groups, the overwhelming majority of these groups is the University of Delaware. It's more than 2/3 of the population. University of Delaware's premium contributions into the GHIP are lagged on a monthly basis. So for simplicity, we assume a month lag for all groups, even though some of them are actually current, meaning they pay July and July, August and August, September and September. So that's the buildup of the expected premium contributions. For FY25, you can see in the aggregate, we expect close to $1.3 billion in total premium contributions compared to the $999 million in FY24. And again, that's just due to the 27% rate action approved for FY25. From an other revenue standpoint, lots of changes going on here for FY25 compared to FY24, mostly due to changes in the EGWIP revenues due to the Inflation Reduction Act. And I have a couple of slides, 3 slides after this, which we'll go into it in a little bit more detail, but you can see sort of a flipping from the direct subsidy going way up starting in calendar 25 compared to where it's been. The federal reinsurance amounts going down, way down starting in FY25, and then some slight changes in the coverage gap discount program. And then from a rebates standpoint, rebates fairly consistent, but continuing to go up, both due to the improvements from the market check that was done, as well as just increased utilization out of the GLP-1 drugs. And then participating group fees, relatively constant from where they were, and then other revenues, which are predominantly made up of smaller other items out of the out of the EGWIP program, things like low-income credits, low-income premium subsidies, things like that. And then $7.3 million bump here in FY24, recall, was due to the cash transfer from OMB to keep the fund cash balance positive at the end of FY24. But going back specifically to the EGWIP components, here are more details about what the impact of the Inflation Reduction had on these components starting in calendar 25. So you can see that in calendar 2024, the amount was expected to be $17 per member per month. The direct subsidy is ultimately the base amount that the government finances in Part D plans, which is what an EGWIP is. Starting in 2025, you can see that number jumps way up from $17 to $118, predominantly due to the big changes in Part D starting in 2025. Recall some of the approved changes on the out-of-pocket max, having it come all the way down to $2,000 under Part D and under the EGWIP. So that's the cause of the big increase in the direct subsidy from roughly $500,000 per month to more than $3 million per month. On the federal reinsurance side, two things are going on here. One is that the amount on a per member per month basis is coming down. So on this end, it was expected to be $91 per member per month in calendar 24, and how much we've been getting actually on a monthly basis. So an average of about 2.7 million versus receiving about $2 million. And that's because the reinsurance piece is split into two components. There's a prospective payment, which you get on a monthly basis, which you can see has been running about 75% of that $91. And then 12 to 15 months after the year ends, CMS does a reconciliation of the actual amounts, and you get a year-end reconciliation payment, typically in the following January, so about 13 months after the close of the year. So two big changes from calendar 24 to 25. One is, while the overall amount is decreasing from 91 to 62, that prospective payment, that amount we're getting monthly, is, you can see in the footnotes here, is going down from $71 PMPM in 24 down to $30 per member per month in 2025. So the prospective amount is going down. And therefore, you're getting, in calendar 25, you're getting less as a percent of the expected total in a prospective payment, which will likely ultimately lead to a much higher year-end reconciliation payment, which the fund won't see until probably January of 27. So two big moving pieces on the federal reinsurance. And then modest changes on the coverage gap discount plan. It's going from $89 per, it should be PMPM, sorry, $89 per member per month in 24, down to $85 per member per month in calendar 25. So those are the reasons for the big shifts and changes in EGWIP revenues in calendar 25. But even though some of the amounts are going down, overall, you can see that the government revenues coming back into the EGWIP are actually big increases versus historical amounts, mostly driven by the change in the direct subsidy. So a net increase of roughly $43 million in added other revenues year over year expected between FY25 and FY24. From a claims standpoint, these numbers reflect, again, those updated trend assumptions that we just talked about. So looking at it sort of group by group, we have that 8% trend assumption on the active and pre-65 medical. You can see bottom numbers that are higher than 8%. That's because of the added changes in enrollment, plus some legislative changes that are also factored into FY25 approved legislation. On the prescription drug side, again, you can see that if you go back to the trend presentation, we had that 29% overall average. With the enrollment added in, it's more than 30% increase. And then on the Medicare side, recall we increased the medical trend assumption from 3% to 5%, and then 11% on the EGWIP. So overall, net overall average, we're forecasting that paid claims out of the fund will increase by more than 14% year over year in FY25 versus FY24. And then lastly, expenses. We assume that expenses will increase by 3% year over year, and anything that is enrollment driven, like per employee per month fees or per member per month fees, those also increase in addition to that 3% inflation assumption increase as covered lives increase. So overall, here's a roll up of the budget on a monthly basis. You can see that the fund will go negative the first few months of the year just because of how the cash flows run, particularly rebates. Rebates run on a quarterly basis. We've discussed it in the past. It's fine that the fund go negative throughout the year as long as it doesn't end the year negative, and then you can see that the fund balance starts to ratchet itself up over the course of the year, starting in November, ultimately where we're expecting a positive cash balance of more than $60 million. And then a little bit more than $34 million after our 2% minimum reserve that we've got built into our forecast assumptions. Breaking down the forecasted results by the three cohorts that we generally now track separately: active employees, pre-65 retirees, and Medicare retirees. From an active standpoint, this group ran at 107% loss ratio in FY24. With the increased premium contributions, the 27% increase, and then again, the trend assumptions that we just talked about, forecasted for FY25, it's expected that active employees will generate about a $40 million surplus, meaning premium contributions and other revenues greater than claims and expenses. In terms of other revenues, this is ultimately commercial plan rebates with also an allocation of participating group fees and other revenues split between actives and early retirees based on claims, but again, just other revenues specific to this group alone. Somewhat similar results from a pre-65 retiree standpoint. This group ran at 108% loss ratio in FY24 and is expected to run about a $500,000 deficit in FY25, or just about 100% loss ratio, again with the same revenues being specific to the active and early retiree populations, allocated based on expected claims. And then from a Medicare standpoint, the group ran at a nearly $9 million surplus in FY24 and is forecasted to run about a $34 million surplus in FY25, again with the other revenues being solely allocated to this group, specific to this group. So not only rebates, but also all of those EGWIP revenue components that we just talked about. So the Medicare population expected to run about the same surplus as the actives, 40 million on the actives and $34 million on the Medicare population. Then from a long-term forecast standpoint, we have two scenarios here. One being if the rate actions were done on an independent annual basis, meaning how much would we need in FY26 to solve for FY26, 27 to solve for 27, and 28 to solve for 28. Because of the FY25 20%, 27% rate action being there, not just to solve for FY25, but also for catch up and recoupment from FY24, the rate action on a single year basis needed would actually be 0%, but that would ultimately lead to much higher rate actions for 27 and 28 at almost 9% for 27 and 9.5% for 28. So we also are taking a look at it from a smooth basis where if we use FY25 as the baseline, what would we need on average each of the 3 years in equal rate actions to get ourselves to the same $0 deficit after reserves projected out for FY28, and that would smooth this 0, 8.8, and 9.5 to an equal 4.4% per year. And then it's just for completeness, we copied back in the pharmacy trend assumptions into the budget forecast. So a lot of numbers. So let me pause there and see if there are any questions relative to the budget development.
Hey, Brian, I should know this one, but this is Bert. Can you remind me again why the minimum reserve would go from 32.3 and 25 to 64.6 and 26?
Sure. So what we wanted to achieve was a minimum reserve that was equal to 4% of expected costs. But because the FY25 rate action was so large at 27%, we only baked in 2% for FY25. So it's just a jump in the assumed percentage that we're desiring from a minimum reserve standpoint. So it's just a jump from 2% to 4%, and then we stay at 4% going forward.
Thank you.
Yeah, Bill Overley, I had a question. Looking at the three groups, the actives, the pre-65s, and the Medicare retirees, and you look at the projected surplus of $34.2 million in fiscal 25, it would appear that that surplus is really there because of the surplus on the Medicare population side. Is that a fair statement?
Bill, I would say partially, right? Because recall, when you look at the actives, we have a similar dynamic on the active side, and that's generally just due to the fact that, again, what I just said a couple minutes ago was that 27% rate action for FY25 gives sort of a double benefit because it was there to recoup some of the losses from FY24. So it's not just solving for FY25 costs, it's solving for FY25 costs and FY24 losses simultaneously. So it adds a buffer in, which basically goes away past FY26. Now, having said that, why I said partially is because the Medicare population was already running a surplus in FY24, where the early retirees and active employees weren't. So it's, again, the answer is yes, but only partially. And we could certainly take these exhibits from a cohort standpoint and not just forecast FY25, but also similarly forecast out the results through FY28 like we do for the group combined. And you can see how, and so we can better understand and see how that dynamic changes over time.
Yeah, that would be helpful for me. I'm not trying to oversimplify this. I know there have been clearly and factually stated that the pre-65s from a loss ratio standpoint are the predominant drag on the GHIP. But also people have made the argument in the past that the Medicare population has a negative impact on the GHIP. And I'm just trying to make the point that, you know, the Medicare population is running a surplus, and in the aggregate, that contributes to the surplus of the GHIP in total.
Understood. And we may ultimately get back to the conversation about what the implications would be of rating the three groups independently.
That'll be a tough discussion.
Yep. Always is, for sure.
Yeah. Thank you.
Any other questions? So hearing none, Leanne, I think we also need to seek approval for recommending this budget to the SEBC.
So actually, I think this information will be shared with the SEBC at Monday's meeting, but I think because it's the first time that they're going to see the budget, they'll discuss it and then it'll come back to them in September for the vote.
Okay, sounds good.
We don't need any recommendations from this group, but you know, if anyone has any additional questions, please, you know, let us know and we can show that feedback with the SEBC.
Great. So the last piece we have here are actual July results. So the July results in here are compared against the budget, the monthly detailed budget that we just reviewed. So from a July results standpoint, premium contributions came in about $1.1 million better than budget, primarily driven by higher than expected premium contributions from the non-payroll groups. Recall when we were going through that explicitly in the budget discussion, for simplicity, we assumed that the non-payroll groups were lagged a month since the majority of that population is the University of Delaware, but there are actually some groups that are paying their premiums on a current basis, again, July and July, August and August, et cetera. So we would actually expect them to come in a little bit better than budget on a monthly basis early in the year. Other revenues were about $1.8 million better than budget. There were two specific credits, unanticipated credits received in July, $150,000 credit on the EGWIP side to offset some administrative expenses, plus a $1.7 million payment from CVS due to performance guarantees. So those are the reasons why other revenues came in higher than budget. Claims were about $7.5 million worse than budget. It's not that we're seeing that same continued dynamic of claims coming in much higher than expected. There was one extra invoice on the weekly invoice on the Highmark side that hit the fund in July that was expected to hit the fund in August. So August will be, or is expected to be, about $12.5 million better than budget. So net on an expected basis, weekly invoices were coming in right about where we expected. And when you smooth out that month end invoice hitting the fund, claims were actually close to $5 million better than expected. So relatively good news from a July claim standpoint. And then expenses were about $400,000 worse than budget, primarily due to higher than budgeted consulting fees, which run on a fairly blippy basis from month to month. So overall, no major expected changes in FY25 results at this point. And then we have the detail in here, as you can see, July in red. Again, almost every single group came in pretty close to what we expected, with the exception of the non-payroll groups, which were driving the $1.2 million surplus to budget. Again, from another revenue standpoint, there's the $150,000 and the $1.7 million credits in July. I circled July and August again because you can see the high mark bucket has that extra week's invoice in it at 48.7 versus an expected 38.2, and then you can see that flip with an expected 38.7 in August versus a budget of 48.3. So again, based on that 1 month's results, about $5 million better than budget. Expenses, again, you can see higher than consulting fees. You can see in budget, the numbers go up and down and up and down. It's simply based on FY24 phasing. But in total, we still expect fees to be about the same for the year. And again, talked about this a couple of times. July enrollment in FY24 was, in that 1 month alone, was a 1.7% increase versus the prior July, and then another 2.6% in July of FY25. So again, we start with the actual July open enrollment results, and then you can see small expected 1% per year increases going forward on a monthly basis, and then just a summary of the actual fund report. So I know I went through that pretty quick. It's obviously early in the year, but July results were on par with what we expected, if not slightly better than what we expected. So I'll pause there for questions.
And Brian, this is Bert. I assume the data breach kind of blips in the data have kind of worked their way through.
Yeah, we based on the information we had received and based on the weekly invoices running through the end of FY24, that was pretty much assumed to be all cleared out by the last invoice at the end of FY24. I think at that point in time, CVS was assuming maybe there was about $1 million backlog, but that's all. That should be all cleared out now.
Anything to read into the pharmaceutical good news, or is it too early to tell? Just watch it.
What do you mean by good news?
I'm just looking at like the CVS commercial versus budget.
Yeah. Definitely too early to tell. I mean, we know that the GLP-1 utilization was way up, and even though those are big numbers, right? More than $3 million a month, it's still a somewhat small portion of the total. It would be nice, but not yet, right? But I hear your point, right? Roughly $3 million better than budgeted on the commercial side. Although the egg whip came in right where we expected, so it may just be a one-time thing on the commercial side. But certainly we'll continue to monitor it, and fingers crossed, right? We deserve a good FY25. So
more
hearing
questions?
no other questions, I will turn it back over to, I'm not sure who's next.
I'll take it. So I think, as Brian alluded to earlier, the FY24 Q4 financial deck was sent to the subcommittee members, so that's there for your reference. And then I did want to correct something I provided earlier in the director's report. So I had said that the bid deadline for the EAP and accident and critical illness was Friday at 1 o'clock. It's actually Thursday, August 22nd at 1 o'clock. So we'll correct that in the meeting minutes. All right, so I think Jacqueline, I think I might be turning over the next item to you.
Yes, that's right. Good morning, everyone, and thanks, Leanne. So for the next item on today's agenda, we wanted to spend some time talking about the group universal life insurance benefit request per proposal, and specifically the scope of work, or said differently, scope of services associated with that upcoming RFP. So for today's discussion, we are requesting a recommendation from subcommittee members on the life insurance plan design options to be included in the upcoming life RFP. In addition to the slides that we're looking at today, subcommittee members also received a draft written description of a proposed scope of services that would be incorporated into the life insurance RFP. In that written description, there are 3 specific plan design options outlined, and these would be potentially options for bidders to quote on in that RFP. So option 1 is a match of the current life insurance benefits. So that would include continuing to offer employee group universal life coverage and group term life options for spouses and child dependents. Option 2 is one alternative design, which would essentially continue to keep the employee group universal life as the life insurance product offered to employees, but there would potentially be some benefit enhancements, which we'll talk about in a few slides. And then option 3 is another alternative life plan design, which would be essentially changing the life insurance product offered to employees and moving from a group universal life benefit to a group term life benefit. And we've talked about that at prior meetings, but wanted to crystallize that option with subcommittee members today. We'll also talk about potentially a 4th option that isn't specifically noted here, but does come into better view once we've had an opportunity to talk through options 2 and 3. So I'll hold on comments about option 4 until the very end. But what we would like to do is focus a little bit further on options 2 and 3 today. And then with your feedback and hopefully recommendation from subcommittee members, we will share that with the information that'll be presented to the SEBC about this proposed scope of services at next Monday's SEBC meeting. So turning our attention to option 2 first. So this is the first alternative life insurance plan design in which employee group universal life as a life insurance product would be continued as part of the offering. So what we've done is we've outlined the different plan design provisions and benefit features associated with option 2, this alternative life design. And the key differences from the current state, the current benefits offered, are highlighted in red. So calling your attention to the first main row under the left-hand chart, you can see for employee group universal life, this includes an enhancement to the maximum coverage amount. Today, the benefit covers up to $350,000 worth of coverage for employee group universal life. And in this alternative design, that would increase the max coverage amount to $500,000. Now, for the accidental death and dismemberment benefit that goes along with employee group universal life, the max coverage amount of one mirrors the other. So you can see in the AD&D line right below, indicating that the max coverage amount is also that increased amount of $500,000. The remainder of the benefit design is a carbon copy of what you see for the current state or the current benefit offering for life insurance today. So a couple of key decision points that we wanted to get input on from subcommittee members today. So the first one is around increasing the maximum coverage limit to $500,000. We've talked in prior meetings that one of the group universal life insurance carriers can administer a maximum coverage amount of $500,000. The coverage limit may be subject to the group universal life insurance carrier's ability to administer a plan with a higher maximum. So for instance, if subcommittee members wanted to look at $750,000 or $1 million, that may be subject to a carrier's ability to administer. We do know that one of the group universal life carriers can go up to $500,000, which is why we've noted that as the proposed enhanced offering you see here. But I'll pause and just ask for thoughts or feedback from the group about the max coverage limit of 500,000. Is there generally a comfort level with that, or should it be higher?
Jacqueline, Bill Oberly. I don't necessarily have a problem with raising the maximum benefit level. But are we talking about this in context of group universal life, or if we were to offer a term option, are you also suggesting that we go to the 500,000, or suggesting
Bill.
that we can?
I'm sorry.
No, I just want to make sure we're not exclusively talking about group universal life here.
Yeah, that's a great point. And for this specific option, we are. However, I think you're starting to go in the direction of what option 4 we were thinking could be. So ultimately, I think for option 2, where we're still talking about group universal life, we would be looking at the enhanced benefit coverage amount here. But then as a potential 4th alternative, we would also like to discuss with subcommittee members, in the event of offering group term life for employees, should there also be an alternative that looks at those higher coverage maximums, just with the different life product for employees, if that makes sense?
Yes, and for my edification, I recall in a previous meeting discussion around group universal life, and that there were very few vendors that offer this as an option. In fact, I thought this was the only vendor that offered it as an option. Is my recollection correct?
Generally correct, yes. The pool of insurance carriers that currently offer and underwrite group universal life is relatively small. So there are 3 carriers in the marketplace today, including the state's incumbent insurance carrier, Securian. The universe of insurance carriers, major insurance carriers offering group term life insurance, is a lot larger. So that's kind of where the discussion came down to about, does the state look at an alternative of group term coverage as a point of comparison against the current group universal life benefit?
In the last RFP that was issued for this benefit, how many bidders responded, or was Securian the only bidder?
Sure. So I can start the answer to that question and then might ask for some assistance from the SBO team, knowing that I believe the last time that this benefit had gone through an RFP process was in 2014, which predated WTW's involvement with the state. But perhaps Leanne or Stephanie, if you could please advise. My understanding was that there were 3 bidders in the last time that the group universal life benefit was procured. Is that correct?
So Jacqueline, you are correct that it was last bid in 2014. And I am trying to pull up some old files to determine who the responses were from. So yes, we did get 3 bid responses, Bill. 2014, it was MetLife, Minnesota Life, and Prudential.
Okay, thank you.
Hey, Jacqueline, this is Bert. I don't know if this is a relevant question or not, but I'll ask it. By increasing the maximum coverage, does that present any adverse effects to the pool itself in distributing that risk among the entire pool, or is it pretty much into the pricing of the book of business of the insured itself?
Well, Bert, to answer your question, I think by increasing the max coverage amount, that does potentially introduce some additional financial risk for the insurer to cover because the maximum is going up, that would be built into the rate proposals that the bidders would come back with.
For the entire pool.
Right. So this is the group. The group life coverage. So because it's a group plan, it would just be rated among the state of Delaware plan participants that are currently in the plan. Does that answer your question?
I think so.
Okay. Are there any concerns about increasing the limit to 500,000? As an alternative for the bidders to quote on, not the only alternative presented in the RFP. Okay. Hearing no feedback at the moment on that, no concerns. The next decision point that we wanted to discuss with subcommittee members is the question of whether the RFP should offer bidders the option to propose other or additional accidental death and dismemberment AD&D benefits that are not currently in the plan today. So right now, there is an AD&D benefit offered to employees who experience a covered event or death or dismemberment through, a series of covered events or accidents. There are other plan alternatives out there that potentially can offer AD&D coverage for spouses and children that are covered under dependent term life plan options. So that would be, a possibility to consider, perhaps as positioned as, bidders can have the option of quoting on a buy-up AD&D solution for family coverage for spouses and children as well. So just wanted to test that with the subcommittee today, if there is any interest in expanding the AD&D benefit that's listed here. Typically, we do see employee AD&D coverage matching the employee life coverage amount. So from an employee perspective, it is pretty consistent with what we see in the marketplace. But again, wanted to test, is there interest in potentially looking at including an option for dependent AD&D coverage?
An option, yes.
Yeah, I'm not opposed to including that in the RFP that bidders are responding to.
Thanks, Treasurer.
Thank you. And then the last decision point noted here, we wanted to ask, should this alternative also include an increased maximum coverage limit for spouse life? So currently the plan allows employees to elect coverage for spouses up to $20,000 of term life insurance. The market medium maximum coverage amount for spouse term life is generally around $150,000. So there is potential room for this plan to consider increasing that maximum coverage amount for spouses under this alternative. So wanted to test that with the subcommittee as well. Is there interest in increasing that amount?
I think it makes sense. I have one question for you though, Jacqueline. If I'm curious as to whether, as we fold in some of these potential items, whether you are able to give us a sense of whether we're getting economies of scale by adding some of these. So for example, if we were to put them together in a piecemeal sort of way, considering the AD&D and the maximum coverage for term increased to 150,000, are you able to kind of give us a sense of whether or not RFP responders are coming close to or beating what we might get if we were to bid this separately? Does that make sense?
It does, Treasurer. We typically don't see separate bids for dependent coverage. The major insurance carriers will really only write group life products where dependent coverage is offered to employees who are electing the life benefit for themselves. So we wouldn't necessarily see a separate procurement for spouse coverage or for child coverage without including employee life coverage as well.
Okay, yeah, so when we're looking at the bidding numbers that come in, it'd be nice to have some type of comparator
Mhm.
to ensure that, we're getting kind of the best pricing.
Sure. We can. And I also think that that's part of why we've outlined these options the way that we have for the purpose of comparison, but also can further layer in some additional commentary to talk about, how competitive these proposals would be relative to other life bids that we've seen.
That's great. Thank you.
Hey, Jack, on the question, this is Bert. So I'd support increasing the maximum coverage. I don't know that, if we're 10,000 or 20,000 right now, I don't know that I would support increasing it sevenfold up to 150,000, but a level of 100,000 or so, I think is reasonable.
Thanks, Bert. Any other thoughts or feedback on these decision points?
Yes, this is Andrea. So I was just curious as to whether or not we've asked the people who are currently participating in these plans what their thoughts are. I don't currently participate in the supplemental insurance program, but they pay the full cost, right? So has anybody asked, is there interest in any of these things?
Happy to start that response, Andrea, to your question, and then I might also ask the SBO to weigh in here as well. Our understanding is that there has been feedback that the benefits office receives from plan participants from time to time. We are aware that an increase to the employee max coverage amount has been something that some plan participants have provided some feedback on or have requested in the past. Not sure if anyone from the SBO would like to add any further color commentary to that.
Yeah, Jacqueline, this is Leanne. So you're correct that, we do from time to time get questions from participants, about the plan design and opportunities for changes. And then in addition, we have gotten feedback from Securian as it relates to the current contract and level of participant participation. So for example, with the maximum amount, the last time that we engaged with Securian on the conversation, they shared with us that roughly 25% of our plan participants are at the maximum amount, which in their opinion warrants this conversation, right? Like, does it make sense to increase it for those that are at the maximum that may want to increase that coverage? So we haven't done any surveying, direct surveying, but we have gotten some information over the years from participants and Securian about, potentially wanting or needing to explore these plan design changes.
Thank you.
Sure.
Just one other point that I'd like to make before we move on to option 3. Prior to today's meeting, we did have some discussion with the SBO about the child term life coverage options and how does that compare to what's in the marketplace today. We typically see that from a market median perspective, most employers tend to cap child life coverage options at $10,000 per child. So the state's current plan, as it exists today, is more generous than what we typically see in the marketplace, because as the state has currently designed your plan, it's allowing employees to elect up to a maximum of $20,000 per child. So we could certainly talk about increasing that maximum amount. Certainly welcome feedback from subcommittee members if there is any interest in further pursuing an increase there. But just wanted to add that color commentary around why we weren't necessarily coming out of the gate and discussing an increase to the child life maximum amount, given the relative positioning of your plan versus others in the market. So not sure if anyone has any thoughts or concerns there, but just wanted to point that out too.
Thanks, Jacqueline.
Okay. So moving on to option 3. So option 3 is essentially intended to help facilitate dialogue with the proposal review committee and ultimately a decision with the SEBC around whether there is interest in moving away from an employee group universal life benefit to an employee term life benefit. So option 3 is essentially taking the plan provisions associated with your current benefit plan, with the exception of moving away from group universal life to term life for employees, but mirroring the rest of the benefit provisions. You'll see that on the right-hand side of the slide that the cash value account and then the ability to take loans against the benefit are not applicable simply because those features are not available in a group term life insurance product. Our recommendation is that in this approach, where the decision is made to offer either group either group term life or group universal life, our recommendation would be that any alternative moving to a group term life product for employees would be offered as a replacement for the current group universal life benefit, rather than offer employees a choice between group universal life and group term life. The reason we're making this recommendation is that by offering a choice would basically limit the state's ability to negotiate the most favorable pricing terms for employees, because the insurers would basically be making an estimate about how much risk is going to be split between one type of life plan versus the other for your employee and pensioner population. So our recommendation is to offer either group term life or group universal life. And we wanted to test that with subcommittee members today. Is there agreement or concerns with this recommendation? I'll also point out before I pause that Securian had recently indicated that if the group universal life plan were discontinued, members could still port their coverage. So they would be able to retain the current group universal life benefit, but would just be charged a higher premium based on Securian's pooled experience with other group universal life enrollees that had also ported their policies. This experience pool that Securian maintains could include other participants who came from plans outside of the state's plan. But that is the trade-off for being able to port coverage. That member goes into a different pool of experience that's maintained by the insurance carrier and not the group plan. So with that, I'll pause and ask if there's feedback on that recommendation to offer that term life plan design as an alternative, as a replacement, rather than as a kind of offered as a choice alongside the group universal life.
This is Bill Overly, Jacqueline. I've been fairly transparent since this subject first came up that I am not a group universal life or, a hybrid whole proponent. I think you get much more bang for your buck with a term policy. And I'm going to try to frame this correctly, going back to the treasurer's comments. I'm just curious, what benefit is there to the employees with a state sanctioned plan versus them going out into the marketplace and simply buying a term policy or a whole life policy? I mean, is there any financial benefit to them to participate in a state sanctioned life insurance plan?
So the financial benefit would be there's a potential for getting better pricing, better premiums associated with being a participant in a group plan offering rather than have that be individually rated based on the member's own specific underwriting risk. It's the same case today when a member who is separating from the group plan either by retirement or when they leave employment with the state. The member has the choice of porting or converting their coverage. And converting their coverage basically means that now the insurance carrier is going to underwrite that individual based on that individual's own risk, own health risk, own age and demographic factors. So in that scenario, much like when somebody goes out to purchase their own policy on an individual basis, the premium rates are going to be higher. And so that's ultimately the benefit of somebody participating in a group plan, whether it's group universal life or group term life, versus going out into the market and purchasing a policy on an individual basis.
Okay. I guess my next question, again, I want to frame this as concisely as I can. Do we have any comparative pricing available? The GUL versus a strictly term policy, what the rates per 100 would be, or per 1,000?
We do not currently, and this option 3 would support that type of comparison.
Okay. All right, thank you.
This is Andrea. For the conversion rate, if somebody said they didn't want to port their Securium plan, they wanted to switch to the group term life, would they have to do the proof of health again?
Generally, no. When an insurance carrier is sort of taking on an existing plan from a different carrier, and those plan participants have already gone through the evidence of insurability or proof of good health process, the carrier taking over the policy will generally honor that prior determination from the former insurance carrier that person met the underwriting criteria. Now, that being said, if a person wanted to increase their coverage with the new carrier, then proof of good health may be required again. But if it's simply, I have, $100,000 worth of life benefit under one insurer, and my policy is going to be transferred to a different insurer through this group plan process, then generally, yes, the new insurance carrier would accept the old life insurer's proof of good health process.
Jacqueline, Bill Overly, as a follow-up, could that be made part of the RFP?
Yes.
Okay, thank you.
Hey, Jack, this is Bert. I just want to make sure I understand. So we're talking about releasing an RFP that has option 2 and option 3 as options for the bidders to bid on, right? And so we'll be getting proposals on both option 2 or option 3 or one or the other bidders, right? We're not talking about choosing today between option 2 and option 3.
Bert, that's right. Yes. So what we're talking about are retaining all 3 of these options, with the third one being just mirroring current state. We are talking about including all 3, just making sure that the components of the 2 alternatives, options 2 and 3, are that the subcommittee is comfortable with what components go into each alternative. But yes, we're talking about including all three in the RFP.
Gotcha, thank you.
My concern is just without having feedback from participants that you're going to end up doing this three-pronged RFP only to find that current participants aren't interested in one or another. And, you know, I will tell you anecdotally, I've heard from a number of individuals who currently participate in the group life who are not interested in the term, partially because, as you've noted here on this slide, there's no cash value option and no option for loans. And there are a number of other features that kind of make it a completely different product and not as beneficial to do a term. So I will say that it seems as though without having some feedback, we're potentially setting ourselves up for a substantial amount of work only to kind of start back at this slide again. Just my thoughts.
Yeah, thank you, Treasurer. Those are good comments, and I think we can take those and discuss internally. You know, as to if it makes sense to do any kind of survey, and how that fits into the timeline and process for the RFP.
Yeah, I mean, I'd also love to hear what the insurance commissioner's thoughts are on the two different products and because again, if we're talking about completely replacing the group universal with a term, instead of doing, giving folks, again, I think to Bill's point, state employees can go out and purchase a term, and it's, I think there's less benefit. There is substantially less benefit by doing group term compared to a group universal. You get a price premium that's much more substantial.
Yeah, and Treasurer, as Jacqueline, I think, may have mentioned in her opening comments, the intent is that we'll have this discussion with the SEBC at Monday's meeting to include, feedback from today. So, the insurance commissioner and others on the SEBC, can certainly weigh in on their thoughts.
Okay, but we didn't necessarily specifically ask for his feedback. Am I right? I mean, outside of this conversation.
That's correct. No, we haven't reached out to him directly.
Okay, gotcha.
So, understanding that there are still some concerns to continue to review and address on just the question of the type of life product offered to employees, whether that's group term or group universal. I'm not hearing any concerns about the recommendation outlined here, which would be offer one and not the other, not both as a choice for employees to select from. Is that a fair statement, or does anybody have any concerns with that?
Well, this is Bert. I'll break the silence. So I guess I agree with going out with a RFP that has these two options, or three options, right? We're not making that decision today on which way to go. So
Correct.
until we see the pricing and what the packages come back with, I don't know that we can make a decision one way or the other. So yeah, I mean, I support doing an RFP with these three options.
Thank you. So just one other comment I'll make before we leave this topic. So I had mentioned in the beginning the possibility of including an option 4, which we don't have prepared content on, but much like option 3 that we do see here reflects a similar benefit design as current state, but with a different life insurance product offered to employees. We had also previously discussed with the SBO the possibility of including an option number 4, which would reflect a similar benefit design as option 2, which includes some of the coverage enhancements that we had talked about a few minutes ago, but would have a different life insurance product offered to employees. So where option 2 still has the group universal life for employees, potentially a new option number 4 would include a group term life for employees, with the additional coverage enhancements, so increases to the maximum coverage amounts, and potentially the option of including a buy-up AD&D for family coverage as other components. So wanted to just test that again, see if there were any concerns about that possible inclusion of an option 4. Again, this is to facilitate informed decision making by the SEBC and Proposal Review Committee about the different options and the price tags associated with each in the market. So if there are no objections, we can certainly look at including an option 4 that has that, similar to option 2, except with term life.
Yeah, I would be in agreement with offering an option 4 as you're describing, Jacqueline.
Thank you, Treasurer. Okay. Well, thank you all for that feedback. We'll take this into account, and we'll include it in a report out to the SEBC at next Monday's meeting on this topic. Perhaps in the interest of time, we can move to the other RFP item on today's agenda, which is to have a similar discussion about the scope of requested services or proposed scope of services for the audit services RFP. So I'll jump over to that content here. And similar to our last discussion about life, in addition to including these slides in today's materials, subcommittee members should have also received a draft written description of a proposed scope of services for the audit RFP. We would like to solicit your feedback on the potential inclusion of a request for proposals from vendors with newer emerging audit capabilities. Currently, the state has a contract with the incumbent auditor, and that contract reflects more traditional audit capabilities, and we'll talk in a minute about what that means. But we'd also like to get feedback on whether there's any interest in obtaining proposals from vendors with more emerging areas of capabilities around being able to audit in more real time. So similar to life, we'll include any feedback we receive from today's discussion with this topic that will be included in next Monday's SEBC meeting agenda. So a little bit about the difference between our audit capabilities and different audit vendors. So historically, most medical and prescription drug claim audit services have focused on reviewing plan experience on a retrospective basis. So claims are paid, processed, and providers and plan participants are providers are paid for the claims that are incurred. Plan participants, pay their appropriate out-of-pocket amounts, and then later on, once those claims are fully paid and processed, a claim auditor would review those. There have been some challenges in obtaining more real-time access to claim data. There's been a number of reasons why. There have been technology limitations across both the medical TPAs as well as the more traditional claim auditors to be able to have a more real-time look at claim data processing. There have also been, as you can probably appreciate, some challenges in getting the right data sharing agreements in place. And beyond that, there are just lengthy claim processing timelines that typically play out for particularly facility claims on the medical side, but also provider claims outside of facilities as well. So there have been several reasons why the market just really hasn't been able to provide claim auditing services on a more real-time basis. The claim processing timelines also include certain activities that are, again, typical for claim administrators, including claims that are resubmitted, having to reprocess those, having to coordinate benefits when there are multiple benefit plans that could potentially pay on a claim. And then, of course, having from time to time the need to recover potential claim overpayments. So these are all reasons why historically and typically most claims are audited on a retrospective basis. And as I said, the state's current audit services contract is based on that retrospective type claim review for both medical and pharmacy. This is true for. There have more recently, over the past few years, been a very small number of vendors that have begun to offer services with the claim of being able to provide a more ongoing and real-time claim audit capability. So looking at administrative claims that have been paid, as well as looking at the fees associated with those claim payments, more on the admin fee side, not necessarily from the perspective of the fees that have been charged and paid by providers. So it's a relatively new capability that we're starting to see play out in a select number of instances. And you know, frankly, this is still an emerging area of the market, but it has been something that has come up. So we wanted to have the opportunity with you all today to talk a little bit more about this and get some feedback on perspectives about including this in the RFP. The vendor marketplace, as I mentioned, is very small. And frankly, for what those vendors can do relative to the more traditional retrospective claim review audit vendors, there's not really any overlap between the audit vendors that do this on a real-time basis with those that look at this on a more retrospective lagged basis. We, in our opinion, don't believe that the claim auditors that claim they can do this in real time are really able to provide the same level of claim review, frankly, because the experience is still evolving and some of the early results have not shown to be as actionable, perhaps as we would have liked to see, as the plan sponsor would have liked to see. So at this point, there are very few vendors that do this. We have very few clients that have partnered with these types of audit vendors. So there really isn't a lot to be shared in terms of the outcomes that various clients have obtained. And as I had alluded to, our perspective is that really these types of real-time reviews would not replace the more traditional retrospective reviews that the state is currently contracted for and has previously in the past. So a couple questions that we've posed here for discussion and feedback. Really just wanted to get a sense from committee members if you have any perspective or preference on whether the scope of services should be reflective of getting proposals for both traditional and more real-time emerging vendor capabilities, as we've just described. The write-up in the Word document, that draft scope of services, does include language for both types of vendors, so again, traditional and emerging, but wanted to take the opportunity today to get some feedback and see if there is any interest in continuing to go down that path of at least getting proposals, while understanding that the overall market experience with these types of capabilities are far less mature than more traditional claim audit vendors.
Jacqueline, Bill Oberly. I believe we had a very similar discussion last month about this in terms of the audit in real time. As you suggest, it's not a mature market yet. So I'd be inclined to stay with the current auditing methodology that we have in place based on your input. Just my thoughts at this point. I guess I had another question. I'm not trying to preempt the public comment section, but I'm curious, once these audits are done, who has a copy of the audit and are they accessible to the general public?
So Jacqueline, I can take that, Bill. This is Leanne. So the audit reports are maintained by the SBO, and they are not currently made available to the public.
I guess that raises a second question. The public is paying for the audits. Why are they not available to the general public?
Yeah, so Bill, we just haven't made them publicly available, but we are working through a process to be able to share those audit reports with the SEBC. And so more information on that will be forthcoming, but we're working through that process now with the Department of Justice and with CTI, who's our current auditing firm.
Yeah, I appreciate that. I guess it's confounding to me that you have a taxpayer-funded audit and the results of the audit on the expenditure of taxpayer dollars is not available to the public. It's mind-boggling to me. And again, I don't want to preempt the public comment section, but you know, it's all well and fine that they be released to the SEBC, but I guess the question that raised in my mind is why haven't the SEBC had access to these?
Yeah, that's a great question. And again, I just don't think it was SBO's practice to share those results. I can share with the subcommittee that when those reports do get shared with the SBO, we do have conversations with the vendors about what's in the reports. And, you know, we work with the vendors to improve, you know, anything that's in those reports from audit year to audit year. So, you know, I appreciate your comments, Bill, and I think we'll have more information to share in the near future.
Well, I appreciate that. Personally, I might even reach out to the Attorney General to understand why these are not public documents. It's just, as I said earlier, confounding to me. You know, when we review the expenditures every month, it would be nice to know that what we're looking at has been audited and verified in terms of their correctness. So again, I mean, I've made my point, but it's something that I intend to personally pursue. Thanks.
Yeah, and thanks, Bill. And I also want to just, for the record, mention that the SEBC would have access to these reports if they're requested. So, you know, just wanted to make that point as well.
But the general public does not.
Correct. They're not posted publicly.
Wow. Okay. Thanks.
No, I was just gonna say, I mean, I agree with you. I think it would be considered for public record as a document which is shared with a public body. Having said that, though, I don't know what I haven't seen one either. I don't know what the content is, so it would require, I would think, legal review for what what is and what is not public record within that document itself. So, but as you know, at least first blush be considered a public record, yeah, I would think it would be with appropriate redaction.
Yes, and to Bert's point, again, you know, it is our intent to make these available going forward. We're working to put that process in place, again, with the Department of Justice and with help from CTI and the vendors themselves. Laurie Ann, do you have a question?
Hi, yes, it's not really a question, it's just like responding to the question, what about the value of the audit RFPs? If the universe for those vendors who provide, those ongoing claim audits is really small, I wouldn't really support the idea of pursuing that type of audit. I think it'd be better to have a larger universe of more proven traditional audit vendors who can respond to the RFPs. So that's what I would suggest, especially if you're saying that there's very limited data on these type of vendors and the quality of their work is questionable because we don't have that data. I wouldn't feel comfortable spending additional money on work that we're not really sure is quality as well.
Hey, Jack, I'll throw my 2 cents on this one too. So my understanding is that the RFP process is it's a 3-year contract plus two 1-year renewals as agreed to by both sides. So I agree that this is not the time to kind of enter that instant audit capability, but perhaps 3 years down the road when that first option is looking at us, the market for that might be a little bit more mature, the technology might be mature, maybe SEBC could consider it at that time.
Thanks. Stephen, I think you have your hand up as well.
Yes, I do. I was just curious if any other states do these real-time audits. I, for one, agree with mostly what everyone else has said, that, knowing that just the claims lag in some of these things are real time may not give you the view that you need to know. But I'm just curious, is there any way we can find out if there was a value to another state in doing it that we're not seeing? I don't know if that's possible, but if that can happen, it might inform this decision in a little different manner. But I tend to agree what everybody else has said. The other thing I wanted to ask you, does the audit look at, and I'm going a little, it's been so long, maybe Willis Towers Wallace can answer this, are self-funded plans, do they have to comply with the ACA as it relates to essential benefits or benchmark plans?
That's a great question, Stephen. So taking your first point, or I'm sorry, so taking that point first, the audit doesn't look at ACA compliance with respect to the state group health plan reflecting the appropriate benefits and coverage with respect to the ACA Essential Health Benefit State Benchmark Plan. That is something that WCW has previously looked into for the Statewide Benefits Office, and we've made some recommendations that have since been worked through with the team on that. So these particular audits would not specifically look at that, though, to answer your question.
Okay, because one of the things I was going to ask in reference that is that if there is a certain procedure, colonoscopies, mammographies, that are kind of required under the ACA, and an insurer, just say, is charging a copay for that, we wouldn't know that through this audit. Is that correct?
That is generally correct, and I might just ask Leanne for confirmation, just having been a little closer to the audit reports. but based on the scope of services outlined, that's not something specifically that the auditors would be looking for. Leanne, is that an accurate statement?
So I'm sorry. So Stephen, ask me again. So are you asking me about preventive colonoscopies and whether a copay was assessed?
Right. Some kind of a screening, you know, the ones that you have to do so many years, and any of the screenings that are kind of required and is under the benchmark and essential benefits plan of the ACAs. So if I wanted to know if an insurer is actually charging for that, meaning a copay or whatever, would this audit tell me that?
So as Jacqueline said, the audit isn't going to look at the essential health benefits or the benchmark, right? But I believe that there is a component of the current audit scope that looks at our preventive schedules, which, for example, would include the colonoscopy at, 45 or whatever the current
Right.
age requirement is. And the fact that in that particular case, there is no member cost share. So the audit would look to confirm that for members who met those age requirements per that preventive schedule, that they were not charged a copay for that visit.
Okay. So we would have to see it under each separate thing, which is fine as long as the information is there. It's good.
Yeah, the auditor would review the claims against the current plan design to ensure that the claims were adjudicated correctly based on the plan design. So to Leanne's point, that would include the preventive benefit schedule, ensuring that members were not assessed a copay for like a preventive screening or exam that they shouldn't have otherwise been charged for.
And that would be regardless if they went to a hospital base versus a a independent lab imaging center.
Well, when you say regardless, Stephen, I just want to make sure I'm tracking. I know that the state currently has a benefit differential for some
Right.
services, right, provided at different places of service.
Yeah, and I know that. So the question is putting that in place, and it is a preventive ACA mandated benefit. All right. Would they be charged that, let's say it's 105, I forget what it is right now, but let's say, would they be charged those fees? So and the reason I'm asking this came up a few years ago where someone said this is an essential benefit. The ACA mandates that preventive colonoscopies, there should be no charge at all. But we have a steerage component as well. So what I'm asking for is, in that situation, would the person be charged, and would the audit tell us that?
Yeah, Stephen, I understand the question. What I might suggest is an opportunity to go back and just confer with the SBO about the level of detail that you're referencing. I mean, our understanding is that the auditor should be able to differentiate that nuance that exists in your plan design alongside of the preventive schedule.
Okay. Yeah, and I
Therefore,
don't need an answer
yeah.
right now. I'm just trying to figure out if, I just picked one preventive screening. I'm just curious to see if the audit would figure that out.
Sure.
Yeah, and the audit would figure that out because part of the implementation of the audit, Stephen, is that we provide currently at CTI as the vendor with all of our plan documents, information to Jacqueline's point about the current plan design, so that when they do their audit of the claims, they're ensuring that the processing of the claims mirror the current plan design.
Okay.
So, whether it's preventive or site of care steerage, like all of that is built in to their analysis of the claims processing.
So let me ask one more question, which I didn't originally have. Sorry. Would what do we do with the findings? Like, let's say there are things like overpayments, underpayment, things like that. What actually happens?
Yeah, so currently, SBO staff meet with DTI, the audit vendor, and the TPAs, and PBM, which are the vendors being audited. And we do review those reports and those findings and recommendations that come out of those reports. And, there's discussion, negotiation, process improvements, things like that that go into place in an effort that when the next audit occurs, right, for the next plan year, that those concerns and findings from the previous audit have been fixed. And so that's kind of how it's been handled currently with the current contract.
Okay. And the other state piece, is that possible on the real time?
Yeah, so to that point, Stephen, it's my understanding that there are other states that have experience with some of these emerging vendors, but I think that those engagements or contracts are so new that there's
Barely know. Okay.
correct. There's no results yet, other than, we know that these contracts or partnerships have occurred very recently.
Thank you
Jacqueline, I'm
very much.
sorry.
Thank you very much.
Sure.
Thanks, Leanne. I was going to respond something similar there.
Okay, good.
Well, thank you all for the feedback. I think overall we're hearing that at this point there is not interest in including these more emerging vendor capabilities into the scope of an upcoming audit RFP. However, there is interest in continuing to keep tabs on how these emerging vendors work with the plan sponsors that have partnered with them to date, and we'll continue to keep tabs on that and provide an update as the market continues to mature in this area over the next few years.
Thanks, Jacqueline. All right, so I think that brings us to other business. Is there any other business from subcommittee members this morning?
This isn't really other business. I apologize. I'm just back to number 5 on the agenda, the group universal life insurance benefit. I don't know that I asked this before in a previous meeting, but was there a reason why we're RFPing this in general?
So Jacqueline, maybe you can help me. But Treasurer, I believe that, or Stephanie, maybe 2 or 3 meetings ago, I think we brought this topic up for the subcommittee because, as you may recall, Treasurer, 5 years ago, instead of going out to RFP, we renegotiated with Securian for the exact same benefit that is in place today, because we felt like, that was most advantageous. So a couple months ago, when we brought this back to the subcommittee with the options of either, renegotiating the current contract with Securian or going out to RFP, I think there was a consensus to go out to RFP. I don't know if Jacqueline or Stephanie have anything to add to that, but I think that's why we're having the conversation we are this morning.
Okay, so it was to go out to RFP for the group universal life, and that's when term was sort of brought into the conversation.
Yes,
Yeah.
and if I could, oh, sorry, Leanne.
Nope, go ahead.
Yeah, and just on that point, Treasurer, term was brought into the conversation, I think largely because the vendor marketplace for group universal life is relatively limited. As we've discussed before, even in this meeting, there's really only 3 insurance carriers today that underwrite for this type of life benefit. So the discussion around term sort of grew around the concept of, well, if term was included as an option in the RFP for bidders to quote on, it could open up the pool of, you know, additional bidders that may participate. So sort of casting a wider net, if you will, around, you know, the different options, the different vendors that could potentially provide a quote.
Okay, and so just my other question, and I know I asked this once before, whether or not we, you know, Willis Towers Watson had pricing comparisons for Group Universal, if, you know, if we had a sense as to whether or not under our current contract, we were getting good pricing.
Because so the short answer, Treasurer, is no, we do not have a reasonable benchmark to compare your current pricing to. Group Universal Life as a product in the marketplace is relatively, I would say, limited in the sense that few plan sponsors are offering this type of benefit now. It's the vast majority offer group term life, so we don't have, I would call it more of an apples to apples comparison with other group life products in the market to really compare the state's current pricing to from a competitive standpoint.
Yeah, okay. I just you know, I've voiced this before, and I'll just voice it one last time, but from a retirement benefit and planning perspective, a group universal plan is much better long term for individuals, and it's much more challenging for a number of our participants to get this type of coverage outside of the state as a group, right? So that's just my concern. And again, it's concerns that I've heard from current employees that are participants. So I just want to make sure I'm voicing it one last time that from an overall scope of retirement planning, we're talking about two different things, very, very different options. So anyway, I appreciate all the feedback. Thank you.
Yeah, thank you for your comments. Any other comments or concerns on your other business?
Yeah, I just, Bill Overly, I just wanted to make a general comment about a path we might follow moving forward. I don't know if there's any value or any other the subcommittee members have an interest in perhaps having a roundtable discussion to help set an agenda. I mean, we come in every month, and Willis Towers Watson does a great job. The agenda's set, and we're limited to that to those parameters in what we discuss. It seems to me, and this is just my perception, that it seems from a pricing standpoint for healthcare, we're always in a reactive mode as opposed to proactive. So I guess I'd like to see us explore some of the options out there. And I can tell you there is a lot of interest in the General Assembly, particularly among the leadership, in looking at the current environment as it relates to TPAs and PBMs. And I'd like to take a deeper dive into that issue because it's going to come back to us at some point. And quite honestly, to have SBO and Willis Towers Watson engaged on the front end, they're going to be engaged anyway if another subcommittee's formed. I'd like to be a little proactive and start to have discussions around those two issues in terms of controlling pricing.
Thank you, Bill. We'll take that back and figure out, you know, what the best path forward there is. Perhaps Stephanie can outreach to you to get some additional information about what you're thinking and how we can weave that into the conversation. Absolutely.
Yeah, again, generally, I mean, I'm not trying to limit the discussion to TPAs and PBMs. There's a lot of bright people on this subcommittee who may have other ideas that we can take a deeper dive into that would, at the end of the day, contribute to significant savings in the GHIP. So, you know, clearly, I mean, my focus personally has been on our TPAs and whether, which I'd like to explore more deeply. It's an issue shared by a number of legislators, whether it makes sense for the state to self-administer the GHIP plan. So, I throw that out there. I may be the only one that has an interest in it within the subcommittee. Again, I know there's general interest in the General Assembly, not only around TPAs, but our PBMs and how that's managed. I think we have an opportunity to get ahead of the curve.
Thanks, Bill. Anything else before we move to public comment? All right, Carol, do we have anyone who has signed up for public comment?
I do not have anyone pre-registered for public comment. Subcommittee members should have received a written public comment that was submitted last week. Is there anyone here today that would like to make a public comment? If you're logging in over the phone, you can hit *6 to unmute or *5 to raise your hand. I do see Steve on the page, so you should be able to unmute yourself.
Yes, can you hear me?
I can hear you.
Okay, great, thank you. First of all, I'd like to thank Bill Oberly for his comment on the audits. I know Bob Clarkin has submitted a FOIA request concerning those audits, and I think it's been 6 months now, and every time he gets a email from DHR saying that's under legal review. And like Bill said, that it's taxpayer money and those audits should be made public. The other part of this, though, is that there should also be an audit on the GHIP to look at the internal controls and everything else surrounding the GHIP. And I don't see an audit on that particular part either. So I would recommend that the SEBC get a public audit on the GHIP as well. And that's my comment. Thank you.
Thank you. Right. So the next one I have is phone number 6099. Is it Tom Pledgey?
Yes. Hey, good morning.
Good morning.
I need a little help in understanding Brian's elaborate presentation this morning. If someone would let me know if I am understanding it correct. On page 14, Brian, if you're still online and still awake, you're showing that the Medicare retirees now have a surplus of $34.4 million because of the 27% increase in premiums. Is that correct? When I go over the page 16, no, make it 17, you begin talking about this concept of smoothing out, which WTW should realize failed, okay? But on that page, that's page 17, Brian, if you go down to, let's go to the page before, I'm sorry, page 16, it says with a 0% increase in 2026, the premiums generated on retirees go up another $30 million. Why are we seeing a 34 plus 30, almost $65 million surplus being built into the budget? Why is the 27% increase in premiums now being considered as baseline, Brian? Unless your numbers are useless. You know, you need to be going back to earlier numbers. The 27% increase was to handle the problem in 24 and 25. I understand that. But the baseline should not be the 27% continuing on. Also, why are you suggesting that you have to go from a 2% reserve to a 4% reserve? You could easily say you want next year a 10% reserve. The reserve should just be there to smooth out some bumps along the way if you guys are doing your job. I don't think you are, to tell you the truth. In fact, I support Steve's idea of an audit And I think there should be an audit of WTW's performance. How accurately have you given us estimates on the budget? You were off by 27%, it cost us. Retirees are going to see increases in their health care through Medicare this coming year. I would like to see the increase of the 27% reduced. We're already paying $34 million more than we're costing the state. Okay, finally, thank you, Bill. Thank you very much for trying to bring some light into the SEBC swamp. Okay, there was very little reliability in what we see. Retirees are still fed up with the SEBC, even with the legislation that was passed. Thank you now. Have a good day. And Brian, you can get my phone number from Rents.
Thank you. Anybody else for public comment? I don't have any.
Just for, hi, it's Brian. Obviously it's not a public comment, but just for clarification, the 27% is not an ongoing baseline. The 27% was the rate action that went into effect for FY25. In regards to the increase in the margin, it was there, built in there to protect the solvency of the health fund, which, as everybody knows, went negative in FY24. So we want to make sure we have enough of a cash cushion. And regarding the retiree surplus of $34 million, as I stated in my presentation, that was relative to the 27% rate action that went into effect for FY25 to not only make up for the FY25 budget, but also the FY24 shortfall, which carries through forward. Similarly, the actives and early retirees will be producing a similar expected surplus in FY25, and would be happy to discuss any other calculations or assumptions.
So if no additional public comments, Carol, I think we are ready for a motion to adjourn.
This is Bert, so moved.
Thank you, Bert. Is there a second?
This is
Second,
Courtney, I'll
Stephen.
second.
All right, I'll take Stephen. Thank you, everyone. Have a great rest of your day.